So a lot of people say to me, hey, Darryl, I understand about the long-term care, right? And I talk about this all the time. My father has dementia, and his bills are really high right now. And I bought care for Jill and I feel very strongly about this. And what I'd like people to understand is that buying long-term care is really a reallocation of resources from one bucket to the other. And if you ask how much does it cost, that's the wrong question. It's a reallocation of resources. But what if all your money is tied up in an IRA? Like if you don't have access to that money? Well, there is a solution to that. So let me share that with you today. So if we have an example, a hypothetical example, hypothetical, everybody's different. 61-year-old male, 60-year-old female, let's say they're in good health. If they were to move $150,000 from a tax-deferred account into what is really a life insurance policy that's designed contractually to handle long-term care, they would have a benefit, a lifetime benefit once they qualify for care of $63,456 per year for each of them for as long as they needed the care. So that's the overall benefit. If they died without using it, they would get $176,000 as a tax-free death benefit. Now, the money's in the IRA, so it is not as simple as I'm laying out, but the insurance companies have a workaround for that. So if the money's in the IRA, we move the money from the IRA into this life insurance policy, there's no tax effect in the year we do it. Then what the insurance company does, they send you a 1099 every year for 10 years. So if this was $150,000, it'd be $15,000 a year, and that's how you pay the tax. Because remember, we've never paid tax on that money. So for that money to go from tax deferred to this tax-free policy, we have to pay tax on monies we've never paid tax on before. So they're going to do that behind the scenes, so you never have to think about it. This way, you can move all the money you need to take care of the care properly from the tax deferred bucket or the IRA into this other instrument that's contractually guaranteed, and you don't have to pay the tax up front in the year that you do it. So it's just one way to do it for people who say, hey, I don't have the liquidity, I don't have the money to do this, and so forth. So I hope that is helpful. If you have questions or comments, you know where to find me. And as always, thank you for watching.